So the next class is about lease versus buy. You know what is leasing? Taking a property on like rental for some fixed period of time, let's say 5 years or 10 years, and running the business activity in that. So there are two parties in lease, that is lessor and lessee. Both the parties sign a contract with each other as per which the lessor will be giving the property or financing the property. It's not financing the money, it's financing the property to the lessee, and lessee, like in return, will be paying rents, monthly rents, yearly payments, monthly payments to lessor. This is slightly different from rent. Rent is flexible, like lease agreements are usually registered. Okay, they are for long period, fixed term, and the lessor cannot ask lessee to vacate the property because the agreement is registered. So till the time the agreement, the lease term ends, the property will be with lessee. Okay, and what happens is when you take the property on lease, from lessee's perspective, any obsolescence in the property and fall in the value of property, lessee is not impacted because of that, because he doesn't own the property, he has just the right of use of the property. Fine. And what happens if the lessee looks for buying? He has to put a lot of amount for buying the asset, down payments or full time or full amount he has to make to buy the property. It's very costly. And if the business doesn't run or go into losses, all this investment becomes worthless. But in case of lease, he just pays a monthly rental and runs the business. If it doesn't work out, like sometimes maybe in lease they may agree, like on these terms also, like uh, if they have an agreement, they can also cancel the lease. Usually it's not cancelable, but depends upon the agreement. He can approach the lessor and he can have a discussion, and they can proceed with whatsoever is good, if like whether to continue the agreement or cancel. It depends upon that. Okay, now we will practically understand whether lease is better or buying is better, like buying the asset is better or leasing the asset is better. Now just a second. So after deciding on the viability of an investment, that means after deciding what kind of investment a investor wants to put into, and they will decide that based upon NPV, whether to invest the money or not. NPV tells them positive NPV, go for the investment, negative NPV, don't go for the investment. A separate decision again may be needed to determine whether a lease would be more suitable source of finance than outright purchase using a loan. So once you've decided that you want to take the project, the next step is whether to buy a property or lease a property for the project. There are two parties, I said, lessor receives the lease payments. Lessee makes the lease payments. Now, types of lease: leases that minimize risk to lessee. Some leases, often which are short-term leases, are just rental agreements between lessor and lessee that are structured so that lessor retains most of the risks of ownership. Yes, because it's a short-term lease, right? Who has the risk of ownership? Lessor. That is, lessor is responsible for servicing and maintaining the leased equipment. That's what. For short-term lease, you need not do anything. You just make the rental payments, and who will take care of the repair and maintenance servicing? Lessor. So here the risk of ownership is also minimized for lessee because if there is a change in technology, then the lessee can exit from rental agreement and at the end of the lease term and is therefore not tied to using assets that are technologically out of date. So lessee can come out of the contract. Leases, when they see that there is a change in the nature of the uh, change in the nature of functioning of the asset. Leases that are purely a source of finance, that means property has been financed here, okay, not the money. Someone has taken the property on your behalf and financed. That means they bought the property and gave it to you. Now, some leases are long term arrangements, that is for long period, 5 years, 10 years, 15, 20, that transfer the risk and reward of ownership of an asset to lessee. That means the lessee can use the property as if the owner is using. Okay, it's like ROU, right of use asset. So as lessee, long-term arrangements that transfer the risk and reward of ownership of an asset. Okay, not the asset but risk and reward. Like a owner, he can use right of use asset. These, see, at the end there can be purchase also. Standards are different in the world. IFRS has different kind of approach. US GAAP has a different kind of approach. US GAAP has 5 conditions, out of which one has to satisfy for the lease to be called as finance lease. IFRS has different conditions. These are agreements between the lessee and lessor for most or all of the assets' expected useful life. If the asset's life is 5 years, lease will be for 4 years. Almost 75% of the life is covered. Lessee is responsible here for upkeep, servicing, and maintenance because it's like he's the owner. He has the right of use, not actual ownership, but right of use. So it's like, he is for long term, he's using the asset. So he has to take care of all this in finance case, not in short term lease, long term lease. Example, this can be a cheaper source of finance than a bank loan if lessor buys a large quantity of assets, aircraft, and obtains bulk purchase discounts as a result. Some of the savings from such discounts can be shared with lessee in form of lower rental payments because they've got the benefit, right? So if it divides the benefit, cost and benefit nullify. Net benefit would be high or cost would be less. Already I've told you about benefits of leasing. Availability. A firm that cannot get a bank loan to fund the purchase of an asset because banks are not willing to give loans. They have refused to give loan. And these people can, what they can do, they can go for lease. Avoiding loan covenants. So loan covenants. See what happens when you take a loan. The banks are always following you. Okay, if you're not able to repay at times, there are strict conditions on you, strict conditions, a lot of restrictions. If you take one loan and until unless you repay, you can't go for another loan. So these kind of restrictions would be there. So loan covenants may act as restriction on the ability of a company to borrow in future. Let's go for a question. Benefits of leasing compared to using a loan to buy an asset can be assessed using a discounted cash flow approach. Note that the assessment of the cost of loan should not include the interest repayments on the loan. Don't take interest repayments, only take the lease payments. They have an example. The NPV of repayments on a loan for 10,000 that is repayable in 1 year at 10%. So you have just taken 10,000. You have taken the interest, which becomes 11,000. And in 1 year, you know, discount factor, the 10% after 1 year, if the amount becomes 11,000, at the rate of 10% discount today, it is how much? 10,000. See, after 1 year, if with interest, the amount has become 11,000, so you discount it at the rate of 10%. Remove the interest. You'll have 10,000. Okay, future value minus interest, present value. Now, the present value of loan payment is therefore the same as the amount borrowed. So the cost of loan is simply the initial amount of loan. Here, 10,000. Now we will see which one is the better option, lease versus buy. Let's go for simple lease versus buy. Just read this. Now, Brown Company has decided to invest in a new machine which has a 10-year life and no scrap value. Purchased now for $50,000 with a bank loan. So there is this Brown Company who wants to invest in a machine, okay, which will have a 10-year life and there'll be no scrap value. So they purchased a machine. They wanted to invest in a machine, those so they purchased a machine by paying 50,000, and the amount what they arranged is through a bank loan. So 50,000 worth of asset is been purchased through a loan. It can be leased for 10 years. That means the property of 50,000 can also be leased for 10 years, and the rental payment per annum is 8,000, which is payable at the end of each year. This is the cost of capital. So we will see whether which is a better decision. See, first, what we'll do, we have to take 8,000 present value annuity factor at the rate of 9%. So 8,000 present value annuity factor at the rate of 9% for 10 years. 10 years term. 6.418 multiply, because of leasing, or if you take the property on lease, the whole future payments of 8,000 for 10 years when bought to present value becomes 51,344. As on today, you pay, if you take the property on lease, it's costing you. But if you don't take the property on lease, the loan is costing you. As on today, see, you're taking a decision today. Taking a decision today. So today, if you are purchasing the property, this is buy. So present value of leasing cost, present value of purchasing with loan. This is simply the loan amount. So if today you're getting the asset for 50,000, okay, and if today the lease is costing you 51,000, which is lower loan, so you can go for this. That's what. So which is the cheapest option? Purchase option. See, leasing also, the amount what you're going to pay to lessor includes the interest payment. It's a combination of principal and interest. It's financing the property to you, right? So any finance would have two things, principal and interest, always. Bank loan, today if you pay, that means today's amount is 50,000. Lease today's amount 51,000. So loan is cheaper. We'll go forward. So there are some points. Costs of leasing using post-tax cost of debt as a discount factor. This could include lease payments and tax saved on lease payments. So cost of leasing, if you want to find out, you should take post-tax cost of debt. That means 9% we have taken. Cost of loan using post-tax cost of debt as discount factor. This could include the cost of loan netted against savings from scrap value of the asset and tax saved from allowable depreciation. That means all adjusted, after all adjustments, they are saying that cost of loan using the discount factor, post-tax cost of debt. That means if sometimes they give you discount factor, which is pre-tax cost of debt, let's say. So you have to do post-tax every time. That means 1 minus tax. Because it is like interest, finance. So cost of loan using post-tax cost of debt as discount factor. So this cost of loan includes what? Whatever the savings you get from scrap value of the asset, and any kind of benefit which you have got which you have got due to claiming depreciation as tax allowable. So the amount here is amount with all adjustments. Okay, let's say X amount, and then you add all the scrap, whatever the scrap value you have, you adjust that, and then you also adjust the benefits from tax allowable depreciation. This is what the entire amount is comprised of. This one, 50,000. Just do this as homework. Lease versus buy. You have to find out the NPV of both. Whichever has the least NPV, you can go for it. So here also we did the same thing. NPV is inflow minus outflow. So like here it was very clear. We have just bought the present values. Approach to single NPV. Alternative method is to evaluate NPV of cost and benefits of using a lease in one calculation. Cost of leasing. If you want to find out cost of leasing, include lease payments and opportunity cost of not buying the asset, including lost tax allowable depreciation and lost scrap revenue. That means when you take a property on lease, you have to make lease payments. But what you're not going to enjoy? You're not going to enjoy the benefits of owning the asset. Okay. When you own the asset, you claim depreciation, as deduction. So this benefit you're going to lose, and also scrap value. So these two you have to forgo. Opportunity cost. Okay, we will do this question. You can just read this. Read this once. Yes, have you read this? Let's understand what is happening here. Okay, the whole explanation, what we have seen there, what they are saying, what comes under lease, what comes under buying, we will take it into consideration. Company has decided to undertake an investment project which involves acquisition of a machine which costs 10,000. This is the purchase price. Machine has 5-year life, no scrap, depreciation. You can claim 20% straight line depreciation. This is pre-tax. We have to convert this into post-tax. Tax rate is 30%. Pre-tax cost of capital. TAD, tax allowable depreciation. Asset is of 10,000, 5 years life. So 2,000 per year. Now, depreciation is 2,000 and the asset will be taken for lease for 5 years. So the benefit, tax benefit, TAD into tax rate. 600. Okay. This is if the asset is owned. The asset is owned tax benefits. On lease payment also, we get tax benefit. 5 payments. So 2,500 out of these are the 2,500 is the payment. Okay. 5 equal lease payments. So on lease payments, we'll take benefit, tax benefit. Lease payment, tax benefits, tax rate. 750. This is the benefit. Okay. Now we will see NPVs. Lease. Lease rental is 2,500. Tax saved 750. The net amount is 1,750. This is for 5 years. Discount factor at the rate of 5%. So these are the fixed payments. What is the 5% is what we got. We have to take annuity of 5%. Just a second. I'm seeing the table. So we've got 7,576. Actually, this is when we this is the net, this is the negative value, positive value, net negative, and this is the NPV with leasing. Now we'll go for NPV with buying. Just just note it down, please. So noted. Shall we move forward? Yeah. We'll see the buying option. So there is an investment of 10,000. You are buying the asset. Okay. And what is the tax saving? Tax saved. Tax benefit on lease is 2,500. Lease payment is 2,500. Investment is 10,000. Tax saved on tax allowable depreciation. Buying option 750. Lease payments 2,500. That makes it to what? 1,750. Oh, sorry, taking the buying option. Then there is no need of this, right? We have taken that in the case of lease. So buying option is there. What is the tax saved on tax allowable depreciation in case of buying 600, I think. Tax saved on tax allowable depreciation. 600 every year. Okay. Discount factor 5%. What was the annuity for 4.3295? Just multiply 600 into this is 2597.7. This is the positive value. 10,000 minus this, negative 10,000 and 2,597.7 is 7,403 negative, because this is negative value. From this, you are subtracting this. The benefit, what you got, tax benefits, present value. You are getting this in the future, right? So when I see the leasing part, it is 7,576. When I see the buying part, NPV because of buying, NPV because of leasing. When I see the buying part, 7,403. So 7,576 negative and 7,403 negative. Which is more? This is more. This is costing more. So leasing is more expensive than buying. Okay, so we'll go for buying of the asset. So leasing is expensive by $173. So go for buying. So we have done this also. Only last topic is left over, which is capital rationing. Tomorrow's class, I will close this. Thank you.